This is FinTech Insider News. This week, we dive into Revolut's plans to bid for a US banking license. We hear all about Cogo's new electrification tool to help optimize energy efficiency in homes and vehicles. And is Klarna considering an autumn IPO revival? We'll be discussing all of this and more on today's show, so please don't go anywhere.
Vitamin Water Zero Sugar has great taste, zero BS, and obviously zero sugar. For those with zero room in their calendar, zero patience for slow walkers, those who get 0 hours of sleep on a Saturday night, have zero filter, zero given, and zero interest in grabbing a plain, boring water. Grab a delicious Vitamin Water Zero Sugar today.
Brace the rudders! Raise the sails! Raise the sails!
Captain, an unidentified ship is approaching. Over.
Roger. Wait, is that an enterprise sales solution?
Reach sales professionals, not professional sailors. With LinkedIn ads, you can target the right people by industry, job title, and more. We'll even give you a $100 credit on your next campaign. Get started today at linkedin.com/results. Terms and conditions apply.
Hello and welcome to episode 987. We're creeping closer to that 1,000 number, FinTech Insider. Brought to you by 11FS, the 5-time Consultancy of the Year that works with banks, challengers and fintechs to build the next generation of financial services. I'm Ross Gallagher, Head of Consulting here at 11FS. Now, with another heat wave on the horizon and an Oasis reunion in full swing, we're deep into a long, hot summer. But is the temperature rising in the world of fintech too? This week, we've got and I apologize for this, champagne supernova of guests ready to turn up the heat on some of the hottest stories in fintech. Joining me to unpack it all are our three panelists. First, we have a fintech insider debut for Brian Spurling, head of EMEA at Cogo. Brian, welcome to the show. Maybe you could tell us a little bit about yourself and your role at Cogo.
Hi, yeah, thanks so much. Great to be here. Honestly, all that talk about heat waves is making me nervous. Cogo is a provider of sustainability solutions for banks to provide onto their customers. So I started out in the product world at Cogo, but I'm now leading the EMEA market team as we bring our new product, which, as you said, is a home energy and vehicle electrification tool into the UK market.
Awesome. Yeah, thank you for coming on, Brian, to talk to us about that. It's always great to get that sort of first-hand experience. Right, next up, we have another FinTech Insider debut for Jasper Sneff, Nanni, Managing Principal at FS Vector. Jasper, again, welcome to FinTech Insider. It's great to have you. Listen, likewise, it'd be great to hear a little bit more about what you've been up to at Vector recently.
Yeah, certainly. Thank you so much, Russ. I'm really glad to be here with you. I'm a long-time listener, but a first-time caller. FS Vector is an advocacy and advisory firm, primarily serving fintechs, banks, and the broader fintech ecosystem based in Washington, D.C., where I am now. My colleague, Kate Flocken, from the advocacy side of the house, actually joined you for a podcast a couple of weeks ago to talk about the state of open banking regulation in the U.S. I come from the advisory side of the house, where appropriately enough for today's topic, a lot of what we've been doing lately is we've been spending time and working with both U.S. fintechs and non-U.S. firms, evaluating whether a U.S. banking charter should be or could be a part of their U.S. strategy.
Love that. Yeah. Very, very interesting and definitely timely with one or two of our stories this week. So thank you for joining us and sharing your insights. Great to have you. And then finally, we have a very welcome return, as ever, to Ruth Foxe-Blader, Managing Partner at Foxe Capital. Ruth, always great to have you. Maybe for our not-so-regular listeners, you can give us a little reminder about your role at Foxe Capital and what you guys have been up to.
Sure. So I am an early stage investor. I invest in fintech and fintech adjacent startups at the pre-seed and seed stage. I have a brand new partner who's just joined Foxe Capital, a guy named Dan DeLasta, an old friend of mine from the industry. And so we are actually kind of in stealth on our launch of our new brand and new investment practice.
Love that. We love a little tease on FinTech Insider, so that's great. And Ruth as ever, look, thank you for joining us. All right, so look, that's our panel. So let's jump into the news. Now, our first story comes from the Financial Times. The headline is Revolut weighs buying US bank to get license. So Revolut is exploring the acquisition of a US bank to secure a national banking license and begin lending in the US more quickly than applying independently. Targeting a smaller, low-cost bank with an existing national charter would allow Revolut to bypass a lengthy US license application process and leverage existing compliance infrastructure. This move is in light of possible frustration with UK regulatory delays. Revolut was granted a limited UK license in 2024, but remains in a prolonged mobilization phase. Most recently, Chancellor Rachel Reeves tried to organize a meeting with Revolut and regulatory bodies, but this was then blocked by the Bank of England to preserve regulatory independence last week. Ruth, I'll come to you first on this. I mean, Revolut, they don't stand still. And I think this is probably another example of that.
Yeah, absolutely. It's, potentially an aggressive move. And it's always hard to know if folks are just kind of flexing or if this is like a huge part of their strategy. I suspect it's a huge part of their strategy. We have an environment, at least at kind of the presidential and macro level, which seems from a regulatory perspective to be friendly to challengers to the existing system. We know that there are quite a few venture capital investors running around the current administration, and that, regulation is being stripped back, which in some senses seems to provide opportunity potentially to folks who want to do disruptive things. I would say as an investor, I prefer clear regulatory guidance and find that sometimes these regulatory rollbacks or kerfuffles cause more problems than they solve. But if I'm Revolut and I'm eyeing the broad sort of general regulatory global landscape and thinking about the most important markets, I think that what you have is the intersection of, the most important market and a loosening of regulatory guidance, and and perhaps the intersection with a frustration with their home market and their home regulator, and so this all feels like a strategic move.
So, I mean, it's such an interesting point on that sort of loosening up of regulation. I mean, Jasper being in the US, does that sort of line up with, I guess, what you're seeing over there? Is there a sort of move towards I guess sort of unlocking growth and sort of making it easier for businesses like Revolut to sort of enter the market from a regulatory perspective?
Yeah, I think there's a strong and well-founded belief that that the OCC in particular, and maybe I can step back in a moment and talk a little bit about the supervisory landscape in the United States, because it is fractured, to say the least. But at the federal level, that the OCC is really going to be very open to innovative firms that are trying to bring something new to the market and make sure that they're able to enter the regulatory perimeter. I think we can speak a little bit more about how that might be counterbalanced in some ways at the state level. But specifically looking at the federal banking charter, firms that hold the federal banking charter are able to preempt many of the state-specific laws and state supervision to make that all much easier.
With an interesting angle to this is because the headline isn't just Revolut to acquire a bank to enter the US market. It's sort of to get a license, and it speaks to some of the frustrations or perceived frustrations with how slow it's moving in terms of, getting those restrictions out of the way with their full banking license in the UK. And I suppose one thing that I'm interested in is, how do you think this lines up with, there's been a lot of negativity, I suppose, around the UK, and we've seen some big moves, right? Just last week, Wise announced its intention to move its primary listing from the UK to the US. Obviously, we're seeing brands like Klarna, for example, who I know we'll talk about later on, choosing to IPO in the US rather than the UK. How much do you think this ties into that general sense of sort of doom and gloom, or maybe that it's not an attractive place to want to do business or IPO?
Yeah, I mean, for the past 15 years, we've had, discussions around the growth stage funding gap in, the UK and Europe. The UK distinguished itself as being an environment where it was fairly attractive to build fintechs, starting about a decade ago. Really clear guidance on regulation, the regulatory sandbox, very similar to, I think, what we're seeing, although perhaps in a funny mirror in the US now, this sort of broad signaling to the market that you're open for business and that you're going to have the ear of the regulator, and that, from a consumer perspective, that the consumer internet is going to change the way people do business. It's going to change expectations, and that the regulatory environment and the market environment is going to be one that favors that sort of consumer-focused building of financial services. We are now definitely seeing that, and I would agree with you. There are a bunch of signals, the Wise signal, the Klarna signal, and also just everything that's happening in crypto and Bitcoin. There's been a concerted effort on the part of the new administration to sort of make the signaling moves that the U.S. is going to be an easy place to do business in. Now, whether or not that is, for the general public good or a long-term sustainable approach, the feeling right now is that there is a window of opportunity which is opening, and I think that we're going to see more flight from other markets which have been perhaps attempting to create a competitive environment to the U.S. towards the U.S., particularly in the spaces of emerging technology and finance.
And one of the things, I suppose, to pick up on that, and it'd be interesting to get your perspectives, Brian. There's been some talk recently about the EMEA really sort of, I suppose, wanting to compete in this space, make it a more attractive market, not just for fintechs to come and operate, but also to IPO, and that sort of ambition to be, to step into that void that's maybe left by what the UK was, is certainly there. Is that something that you're seeing in the work that you're doing in EMEA?
Yeah, to an extent. I'm struck by you talking about, a sort of 10-year period there, and the decision Cogo made 2017, 2018 explicitly to come to the UK, because back then our product hinged on open banking, and the UK was the first frontier on that, and it was where we were going to be able to launch the product and have success, which totally turned out to be true. Now, we tried over that time to break into the US market, and we struggled mainly because of that open banking restriction. So I feel like, yeah, the history has led us into the UK, and I'm interesting to hear the shift that's happening now, and whether or not we're going to see our work in the UK sort of struggle in comparison. It's interesting to look forward to that.
Yeah, absolutely. I think another interesting angle, Jasper, is I suppose the differences. I suppose we've talked about regulation, we've touched a little bit on open banking, but then I suppose also the differences around consumer expectations. I mean, Revolut is such a great example of a fintech that seems to have been successful in so many different parts of the world, and actually maybe sort of go against the grain in terms of some of the traditional thinking about, you've really got to localize the proposition to make sure that it meets sort of local expectations, appetites, etc. Is there anything that sort of stands out for you that maybe represents a bit of a challenge or a pitfall for a brand like Revolut trying to enter the US market and be successful in that sense?
Well, I think there are a number of things that I think about here. One is there are lots of companies that are eager to, consumer companies are eager to enter the US to have access to the US consumer market, which is huge, of course. But I think we see a lot of companies come into the US kind of thinking that they're coming into one market and finding out that actually, for a lot of purposes, they're coming into 50 markets, each with their own rules and supervision and oversight, which is, why there's such an emphasis for so many companies put on the role of banks and their ability to preempt certain state level considerations. And that's why you see a lot of companies launch in the US. I think that the typical pathway is through a bank partnership, but also, who want to pursue their own banking licenses for that reason. I would say from a consumer expectations standpoint, I also feel like the U.S. is there's a lot of opportunity here for firms that come in, because we have great homegrown fintechs like Chime, who are serving a part of the market that is basically underserved by traditional financial services. And I think we see some of the tools and products that exist in other jurisdictions and say it would be great for those to come here, for our consumers to be served by them too.
Yeah, absolutely. Makes a lot of sense. Ruth, I guess the final sort of consideration on this, and it'd be remiss not to miss it, not to discuss it, is the point about Rachel Reeves, and getting involved and trying to bring all parties around the table to help resolve this, which I think, lines up with what Labour have said that they're trying to do in terms of really accelerate and prioritize growth, but also in engaging regulators across several industries and trying to understand, like, how do we unlock that path to growth? What is your reaction to, I guess, that being blocked? Was that the right course of action by the Bank of England, or does it kind of show them actually, I suppose, as being a bit of a blocker to some of that growth and progress that they're talking about?
I think it's definitely probably too soon to tell, right? Like, we'll see how this all unfolds. But I think that it goes back to your previous point around, so much of particularly venture capital, and it even feels like the public markets these days are just so incredibly emotional. And so, the kind of signaling that we're still open for business, at the highest levels of the government, we're going to work to make this, blue chip company have an effective relationship in its home market. All of that is very important. It's sort of sending the message to not only companies that are building in the space, but also investors that it's a vibrant and viable market. And then having like a sort of high profile blunder, is just another sort of chink in the armor. And to your previous questions, like, are we open for business or not? Like, what's really going on in the UK? Is the UK kind of a has-been? Are there other markets? These questions tend to be self-fulfilling prophecies and something that's as emotional as, venture capital.
Yeah, completely agree. I think it's a fascinating story, and it's one that we will definitely keep an eye on. But for now, I am going to move us on to our next story, which comes from FinTech Finance News, with the headline, Cogo strengthens product portfolio with the launch of electrification tool. So Cogo has teamed up with ASB Bank in New Zealand to unveil the Better Energy Calculator, a tool to help homes and vehicles transition to electrification. Users can input property and vehicle details to get personalized estimates on energy savings, upfront costs for upgrades, and annual financial benefits. The tool merges climate action with consumer savings, aligning with Cogo's mission to empower individuals and businesses to reduce their carbon footprint through banking integrated sustainability tools. Now, Brian, obviously we're very lucky to have you here to give us a sort of first-hand insight into the product. I think, for me, what I love about you guys and what you're doing is we all know that we should be doing more to reduce our carbon footprint and our impact on the environment, but how we do that, I suppose, isn't always clear. And I think the solutions that you guys offer makes that super actionable. And I think this is just another example of that. It would be great if you could just give us a little bit of an insight into the product.
Yeah, brilliant. So yeah, as you said, this is a tool that takes a homeowner from the time that they first think about upgrading their car to an EV or retrofitting the energy systems in their home. So from that first point all the way through the journey to the point when they complete that. It is engaging and interactive by design to help people move through that journey. And it essentially allows you to design your perfect retrofit. So it presents the retrofit options, and we're talking about an induction hob or a solar panel or a heat pump or a battery or an EV. You put that retrofit design together, and then in real time, the savings that you're going to make on your monthly energy bill are calculated and presented back, so you can see what impact it's going to have. But the key thing about this tool, the three massive challenges that it solves that are vital to this. Firstly is the upfront cost. So the cost of an EV, we all know, is not insignificant, but also the cost of a home retrofit, can be huge. It depends a bit on the home, but you're always talking about a lot of money. So we're integrating the green finance from the banks right into that cost model, into that user experience. The second problem that it solves, that equally important to the homeowner, is the marketplace of installers and suppliers. It's early days. That marketplace is a bit of a wild west at times. There's a lack of trust, there's a lack of credibility there. So we're bringing that marketplace into the product as well, with the backing of the bank to bring that credibility. And then the third problem, which is much more a problem for the banks, is a sort of a data tracking visibility problem. So at the moment, the banks are kind of lobbing people over the fence and hoping that they find their way on their own. And that's often not working, especially with some of the installers facing challenges in supply. So we are connecting the dots with the data under the bonnet to make sure that we can keep track of users going through that journey.
I mean, that's brilliant, because they are three core problems. I think when you think about this, I think what puts a lot of people off even starting the process is an assumption that the cost is going to be prohibitive. Will I even save any money? So quantifying that up front, just arms people with the information that they need to make those decisions. The marketplace of installers, like you said, I mean, this certainly isn't reflective of everybody, but I think we've all heard horror stories about, whether it's insulation and installation and all of that sort of stuff, and getting left in that situation, which people don't want. And of course the tracking piece, to make sure that you've got that joined up experience, and you from the very beginning to the very end. So three core problems that I think this solves. I guess partnering then with the sort of bigger bank providers, that's a route to sort of scale, I guess, in the simplest terms, and helping to accelerate the sort of the rollout and adoption.
Yeah, exactly right. But the synergy is remarkable. This is a win-win-win. So it's great for the customer, it's great for the planet, but it's also great for the bank, because the influx of finance that's required to help people make this transition is so huge that opportunity for the bank aligns their commercial priorities with their, I guess, the sort of the moral imperative, but also their own carbon accounting imperative. So that we can maybe get into the details later, but there is a significant challenge that banks face to reduce their finance emissions, and that is essentially every time a boiler gets turned on in somebody's home, if the bank has a mortgage on that home, the bank is picking up the tab for those carbon emissions. And we all talk about the carbon footprint of AI, with the high electricity demand that comes with, but in reality, the mortgage emissions of a bank are multiple times bigger than the entire footprint of every other part of their business. And it's the trickiest problem to solve. So yeah, you're seeing the banks needing to reduce their financed emissions. You're seeing them looking for an opportunity to extend their market share of lending. And then at the same time, customers, want to improve the quality of their living environment and, reduce their carbon footprint. So yeah, it's a case where really all benefits align, and there's a real huge opportunity to plug into there.
Yeah, and I think that model is really core to what's so clever about this, right? Driving that alignment and creating that win-win-win dynamic. I mean, Ruth, as an investor, that's not a bad look, right?
Yeah, definitely. I've been investing in this space for a long time, also in a company in the UK called Home Tree. And our thesis was really that the micro infrastructure of the home is a huge and important part of solving, the kind of carbon emissions and sort of greenification challenge that we need to solve if we want to confront climate change. And I think what we have seen is that bolting together the opportunity to move from a boiler to a heat pump and to include green infrastructure in the home with financing and maintenance and other financial products like insurance is a huge value proposition to consumers.
Yeah, exactly. And I think it's one of those things that we do all feel that imperative, but it's about making it as easy and as accessible as possible. Jasper, what was your reaction when you read this story?
Well, I to the point I made earlier, I think I'm always hearing about consumer products that are available in other jurisdictions, and wishing that was something we had in the U.S. I'm sure that the policy environment maybe makes it such that the economics here are not quite the same. But even just on a practical level, it's an issue that everybody has. Just in group chats I'm in conversations with friends, we might be talking about, the NBA finals 1 minute, and then the next minute everybody's saying, what was your electricity bill this month? Why is mine so high? It's something that, putting aside the moral imperative, putting aside the role of banks, it's a key consumer issue.
I mean, that's a really important point, Brian. It's not just the moral imperative. We're all feeling this now in our pockets every day, every week, every month.
Yeah, and we've really noticed that at Cogo. So we've been working with banks for 5 years to bring carbon tracking solutions to their customers, and that was very much a carbon focused proposition, and that works really well for a subset of customers who are carbon conscious and they want to track their carbon footprint in their spending, via their spending. And actually, if you're a NatWest customer in the UK, then you can still do that. You can still use our solution via the NatWest mobile app to look at your carbon footprint on a day-by-day basis. But it's a limited proposition to those customers who are engaged in climate, who are thinking along those lines. What is so interesting about this home energy space is that you can take a customer through the entire journey and not mention climate once in the entire thing. It starts with a cost saving. So the way we're pitching it to the banks is, yes, you've got carbon conscious customers coming in via the carbon experience, and that can start with the energy transaction appearing in your transaction feed. We can calculate the carbon footprint of that, and we can talk to you about your ability to reduce that carbon footprint. But separately, there are customers who are, as you say, just looking at the cost. And there's the same conversation there. You can cut your electricity bill your energy bill by £2,000-3,000 a year. And that conversation then continues all the way through to the retrofit without ever having to mention the carbon footprint. I think that's the remarkable thing about this, is the opportunity here as the technology, the electrification technology, really accelerates, and we're seeing huge gains in efficiency, the reduction in cost of solar panels, the ability to charge your car from your own solar panels, and then basically drive for free. This is a level of experience in our lives that I think a lot of people are haven't realized yet just how profound and exciting that's going to be. We're in an early adoption stage at the moment, but I think it's absolutely on the banks to propel us into the steeper part of the adoption curve and see that flood of people come through the door and capitalize on that, benefit from it.
Yeah, a level of experience, and I think the way you described it, a level of independence that I think you're right. People probably haven't quite comprehended yet. To the point, Brian, just about the adoption curve. How damaging is it that banks sort of almost en masse have withdrawn from the net zero banking alliance in the UK? Lots of the US banks started to sort of roll back some of their sort of greener policies in the run up to the Donald Trump inauguration. With through that lens, how damaging is that?
Yeah, I mean, with hindsight, we could say there's a reason that we're not pushing the US market first, and we can all feel very smug about that in Cogo at the moment. But no, just a quick explainer on this. So yeah, at the beginning of the year, we began to see the mass exodus of US banks from the Net Zero Banking Alliance. And, there's some big names in there. It's a long list, and there's some big names. The first big international bank to go was HSBC, and then Barclays very recently as well. I think the first thing I'd say is people sort of missed this from the list. Triodos have also dropped out. Now, Triodos, for anybody who doesn't know, is very much the darling of the green finance world, can do no wrong. Now, their stated reason for dropping out is because they felt like the commitments were being watered down, which is not what Barclays has said. Barclays has said more that it's no longer worth being there because, nobody else is there. They're sitting in an empty room, which, when you look at the list, isn't entirely believable. But I guess with Triodos dropping out as well, it just does raise the question of just how much emphasis do we put on the Net Zero Banking Alliance versus the bank's individual targets and their commitments. We're not seeing any change on the ground yet with our existing clients and the conversations we're having with our prospects. We will be the first to be holding feet to the fire if anybody begins to waver. But actually, I'm optimistic, and my optimism comes mainly from the degree of sort of institutional memory already baked into the carbon accounting system. Financed emissions as a concept is just not going anywhere anytime soon. It would be such a huge international radical change to the carbon accounting system. And because, as we've talked about, the alignment with commercial value, I just don't see it's in the bank's interests to back away from this. And just, I guess, as a personal anecdote, I happen to be trying to get a mortgage at the moment. I'm dying to look at my phone and see what's been going on in the last couple of hours. And I asked our mortgage broker to choose our mortgage provider based on who was offering the most generous green grants, because I knew that we will be electrifying our new home in the coming years. And as it happens in the UK at the moment, that's Barclays. So, from where I'm sitting, we're still feeling pretty confident, even if it's not a good look when it hits the news.
No, it's a brilliant perspective. It's easy to look at those types of headlines and think, "Oh no, everything's falling away, and we're going in the wrong direction." But it's good to hear your optimism, and that's not necessarily the case. All right. On that note, we are just going to take a quick pause, and we'll be back with you very shortly.
Hey, it's Paris. I love sparkly things, right? Like stars. Duh. And thanks to Hilton and AutoCamp, I just slept under them. Picture me, serving looks by the fire outside my luxurious Airstream, making s'mores with the kids, while a national park is our backdrop. The great outdoors meets Hilton hospitality. That's hot. Explore all the new ways to stay at Hilton.com. Hilton for the stay.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's vanta.com/insider.
Before we dive back into the news, I wanted to tell you about another FinTech Insider Insights episode you won't want to miss. This week, we're joined by someone who truly operates at the crossroads of regulation and innovation, Colin Payne, Head of Innovation at the FCA. You're likely familiar with the FCA, the Financial Conduct Authority, one of the UK's leading financial regulators. But how much do you really know about the role they play in shaping innovation across the industry? And more importantly, the man leading that charge. In this episode, we explore the FCA's brand new AI Sandbox initiative and hear directly from Colin about his vision for restoring the UK's innovation mojo. It's a fascinating conversation that had David Breer buzzing, and we think you will be too. The episode is out now. Just scroll down to the podcast right below this one. And now back to the news. Our next story comes from TechCrunch with a headline, AI-powered fintech Alaan raises $48 million, one of the largest Series A rounds in MENA. The raise comprised of primary and secondary funding, making it one of the region's most substantial Series A investments in fintech. Founded in 2022 by ex-McKinsey consultants, Alaan has positioned itself as a leading AI-powered spend management platform in the Middle East. The platform uses AI-driven automation, including receipt matching, VAT extraction, and reconciliation to free up more than 1.5 million hours of finance team labor to date. The company is already profitable, generating around $10 million in revenue from a $5 million prior investment, highlighting strong capital efficiency. Ruth, look, I'll come to you first on this one. How interesting is the Middle East right now from an investor's perspective? Like last week, we had a story about the UAE sort of leapfrogging the UK as a sort of on its IPO returns, primarily though driven by the $2.2 billion Binance deal. But this again is just another tick in the box for the Middle East.
Yep, it looks like it's cooking. I think if you think about these markets where infrastructure lags behind maybe some more traditional focus markets for venture capital like the US or the UK or Europe, and there are a lot of opportunities, and there's also a little bit of a playbook for building these really successful companies. I mean, I don't think that this is coincidental, where we've just seen this week big news from Ramp. Why not kind of rocket internet it and build some copycat companies in a region that is lacking infrastructure? It sounds like a great idea.
No, agreed. Totally agree. Brian, again, I know the Middle East is in a market that you're looking at and you're interested in. I mean, I guess you've got that sort of real top-down mandate coming from government. If we look at sort of Saudi Arabia, for example, their Vision 2030, really wanting to diversify the economy away from oil and gas, and I suppose the capital that's available to startups, scale-ups, people looking for an exit in this market. I guess it's not really a surprise that we're starting to see some real activity here.
Yeah, exactly. And it's a region of the world that has a lot to do on this and a lot of potential as well. The thing that I'm actually most interested in this story is one of our existing products is carbon accounting. And I've talked about the consumer side of that, but we provide that for businesses as well. The ability here to be pulling out using AI to sort of automate the receipt matching and get that extra granularity of detail in the spend is just that's a huge boost to the ability to accurately carbon footprint. So I'm looking at this from two angles. I'm looking at the energy in the region for no pun intended for these types of scale ups and work in this area, but also just the technology that's coming out and the opportunity to get better data and more granular data flowing into the carbon models.
Yeah. Love that. Jasper, what sort of struck you when you read this story? What kind of stood out for you?
Well, the first thing that struck me was just in the intro paragraph. I have a past career, not at McKinsey, but in consulting, kind of similar to that, and have that experience of trying to use my corporate Amex when traveling abroad and just not being able to connect the dots. To end up spending a weekend every week, or about 4 hours going through and uploading all of the receipts. I think it's something that although there are, to Ruth's point, in other places that have some of this infrastructure already, there are lots of providers who are making this easier. It's still I think you have most companies are not taking advantage of all of these spend management tools, and I look forward to a future world where the traveling consultant can finally rest when it comes to receipts.
Yeah, I mean anything that cuts that that administrative burden, right, and just kind of lets you get on with the stuff that it is that you're passionate about and that you want to do. I think is a win in my book, right? And this feels like an AI use case that just makes sense, right? I guess another thing, Ruth, that sort of stood out for me is, so they launched in the UAE, they've already expanded to Saudi Arabia, they're profitable, and now this big raise, I mean, it kind of speaks to a level of ambition here, right?
Yeah, it's kind of like what's next because, profitability, while great for kind of, lifestyle business is not the aim of an early stage company. And so clearly, if they're raising capital, they've raised it on the story of making investments in sort of new things. A lot of what we're talking about today, both Revolut and eventually this kind of Klarna news really speaks to the deepening of value propositions and the kind of acquisition of infrastructure by fintech companies to become more valuable and to make a play for more traditional companies ultimately. And so, it'll be interesting to see if these companies in the MENA region follow this path and follow it more quickly, because the path has certainly been laid down by, let's call it, incumbent fintechs in other markets.
It is so interesting though, Ruth, because, if we look at, some of the raises in the region in sort of Q1, Tabby was the largest at $160 million, and then a couple around the sort of like $30 million. And then already in Q3, we've seen some, like a real uptick, right? I mentioned the Binance deal and a couple of others. I think it's easy if you look at this from the outside to kind of go, oh, this is an anomaly, it's a flash in the pan. But actually, if any region sort of knows how to like really accelerate these types of things, then it is the Middle East. So do you think this is indicative of like a wider trend?
Well, it's sort of what you were talking about before with looking at the kind of stock markets there and creating possibilities for flotations. Ultimately, the venture capital market is going to be as mature as the liquidity market in the region. And that's why we've always seen such a great interest in the US market for venture capital, because there are, acquisitive companies that are in a position to pay high prices for startups. And there's also, a very liquid IPO market, which has, really been in a bull market environment for almost 20 years. So we can really understand why it's a great place to build businesses. And I think that if we are seeing sort of baby steps toward maturity in this market. And part of that is because we're seeing more investor activity. We're seeing more opportunities for late stage funding. It's my assumption that we'll see more happening on the IPO scene, albeit, not as vibrant as maybe some other mature markets, but certainly indications that there are liquidity opportunities and then acquisitions in the region, which will, if that does continue at pace, we will see a maturation of the venture capital environment.
Yeah, I couldn't agree more. And Brian, final word to you on this one. What about, you mentioned the benefits of AI when it comes to, carbon accounting and everything that you said. What about the prospect of the Middle East becoming a real leader in that sort of green energy space?
Yeah, it's such potential. I mean, just like obviously the amount of sunshine there. When you look at the just comparing the stats between New Zealand, where ASB have launched, and the payback period on a set of solar panels, and then trying to apply that to the UK market, where it takes a number of extra years just to get enough sunlight to get that payback. I was talking to somebody from Middle Eastern bank just a few days ago, and we, the vision of a solar panel on every roof or even on public buildings and so on, collective energy, it's just huge there. Needs huge investment, needs the same problems we have here, consumer demand, as well as central government incentives. But needs to happen, and it's going to happen because that price point has been reached now, and it's almost just the market sort of waiting to wake up to that and catch up to that before we see that solar's really going to take off there.
Nice. All right. I'm going to move us on to our next story. This one comes from Finextra with the headline, Klarna considers autumn IPO revival. Klarna is preparing to formally restart its US IPO in September or October 2025 after pausing earlier in the year due to tariff-driven market disruption. The firm is targeting a $15 billion valuation and plans to raise around $1 billion as initially planned for its March filing. Klarna is now operating with an electronic money institution or an EMI license from the UK regulator, enabling expansion into full banking services. In 2024, Klarna generated 2.8 to 2.81 billion in revenue, up around about 24%, and achieved its first net profit of around about $21 million, reversing losses from prior years. The company recently secured high-profile deals with DoorDash, Stripe, Walmart OnePay, eBay, JP Morgan Chase, and Apple Google Pay, strengthening global reach ahead of its IPO. Jasper, I'm going to come to you first on this. I mean, obviously, when they were planning for their IPO earlier in the year, and then, of course, the announcement around the tariffs, and it got completely derailed. They were very unlucky. But what's your sort of reaction to this big sort of fintech coming to IPO in the US?
Well, I'm sure that Ruth will have a strong opinion on this as well. But I think that there's a point of view, in a sense, in the community in the US that to a large extent, fintech is back, and we see that reflected in the IPO market. I think this is, people point to the Chime and Circle IPOs earlier this year as evidence, and I think it's something that we're all very happy about.
Yeah, absolutely. Ruth, come to you, get your thoughts.
So many thoughts here on a bunch of different vectors. One, great, this would be so exciting. And I think we've seen, as Jasper said, there's some really dynamic IPOs that have happened, and, the big ones that we're all conscious of. And then even, not in the fintech, but in the tech space, the recent Figma IPO, in the insurance space, the Accelerant IPO, just, really demonstrating investor appetite for new propositions. And, this would be, I think, if I were Klarna, I'd be thinking really seriously about this, obviously, because it feels like there is appetite, investor appetite at this point. Things can always change. We do not know what's going to happen tomorrow. And so I am not a betting woman at all on the macro, because it is so incredibly volatile and dynamic right now. But for the moment, feels like the prospect is nigh. The other thing I think is really cool is that the idea of going into this banking license and thinking about other propositions demonstrates, and I think just the partners that you listed demonstrate that there are more viable open banking programs than perhaps people are really thinking of. There's been a sense that, first of all, open banking has really stalled, and that the kind of ownership and sharing of consumer data, feels a little bit impossible in the US. And maybe that's changing, despite the fact that we're having some, lack of regulatory guidance here. I really believe that we need to have solutions around open banking to assist with creating a secure data sharing environment, and to allow third parties to safely use consumer data in order to provide better customer experiences. And I think that we're seeing that starting to happen. I think one of the things that we have had in the US has been a fairly stable environment where you have, digital banks or some digital interface that can do some of this work. And the question I've asked as an investor is, how many great programs are there? How much need is there in the market? And what I'm really feeling like is that there is more need than capacity at this point, which means there are really cool potential investment opportunities. And so just everything about this story is really exciting to me.
And I guess this being like a large later stage raise, Ruth, probably frees up exit probably frees up some capital that can then be reinvested into some of those earlier stage startups, right?
Yeah, this is going to create liquidity for a lot of people. I think one of the interesting things that's happened in venture capital over, since sort of the Gen AI boom is that we're also seeing private companies make fairly large acquisitions of private companies. So, all bets are a little bit off. I think that for me, I remain excited about really big market opportunities no matter what, because I think that there's always investment for great companies, and that actually potentially building in more capital efficient manner can yield better returns both for investors and founders. So, I don't feel super rah-rah about just dumping money into any project. What I'm really excited about is the signaling around this indicates to me that there are more interesting, innovative projects to be built. And, are Klarna investors, potential investors in those projects? They probably already have the money to invest anyway. Is Klarna a potential acquirer? They probably could already acquire anyway. So it might not change things tremendously. But again, going back to my earlier points around emotion and market signaling, any positive IPO is a good thing for fintech.
Yeah, completely agree. Brian, what was your sort of reaction to this story?
So I'm going to be the sobering voice of negativity in the room. I agree with many things that you're saying there, Ruth. The fund freeing up the sort of the other projects that this indicates are possible, exciting. But overall, for me, I just can't shake Klarna's intrinsic, how it's intrinsically tied to modern consumerism, and the extent to which this business model both encourages and relies on in a sort of a symbiotic cycle, and that whether it's fast fashion or fast whatever. From a economics point of view, exciting. From a climate point of view, Klarna is not the future that I would hope for us. So yeah, that's my sobering take on this story, unfortunately.
Fast pizzas.
Yeah,
that's right. And look, of course, there have always been question marks about the fast fashion side of things, and of course the impact on the environment, and then of course that it's intrinsically linked as well with consumer debt and the impact on consumers. Jasper, I'm interested on, we mentioned a lot of brands when we ran through the sort of overview of the story, right? So DoorDash, Stripe, JP Morgan Chase, like big brands. They've also sort of announced in their most recent figures that delinquency rates have declined. Does it almost feel like Klarna are in a stronger position to IPO now than they were maybe when they had initially set the ball rolling back earlier in the year?
Yeah, I think it's hard to say, maybe without having access to all of the indicators that they have internally for their own credit exposures. I mean, I think it's something where when you're looking at these short-term, they're more liquidity products than they are credit products. They have access to a lot of consumer data that helps them really understand what what likely delinquency profiles are going to be when they're looking at a product that only has a lifetime of a few months or a few weeks. I think that's something where they will have only gotten stronger in terms of understanding what consumer behavior and consumer repayment looks like. I think anytime they add a new vertical, I'd be curious whether the repayment economics for the DoorDash partnership might be different than some of the others that they have. But I think they're always accumulating data, and they're always sharpening their models, and they're always getting better at what they do.
Yeah, and Ruth, look, I'm going to give you the final word on this because it just makes sense. How do you think the market's going to react to this? I mean, you made the point earlier on that it's still a very volatile time, but do you think they can be optimistic?
I mean, don't know, right? I'm not going to predict, but I think all things being equal, I do think that this is a better moment for them. I think that a lot of the Trump terror, volatility stuff feels like it's in the cake. Is that going to kind of change over the course of the summer? Possible. So, that's why I refuse to make any predictions. This is like a part of a bigger macro story. But we've had, as far as Klarna goes, the business is very well known to investors. The data's out there. There's a lot to like. There already are a bunch of kind of adjacent revenue streams and vectors for growth beyond the core lending. And we have seen some quite successful IPOs. So, today, I think it looks positive, and And a positive IPO, of course, will continue to have this sort of virtuous cycle generally for the broader fintech scene. But again, we're kind of in a bigger macro environment that is, feels pretty unpredictable.
I think it's really smart not to predict because, I mean, who would have predicted the whole tariff fiasco last time out, right? That completely derailed the whole thing.
Yeah, who would have predicted the whole tariff fiasco and it having like zero impact on the equities market? So, it's like it's very difficult to sort of to say what's going to happen next. But all things being equal, I can completely understand why this is a news story this week.
Yeah, couldn't agree more. All right, excellent. Now we're going to move on. Just a quick look at one more newsworthy story this week that we don't have time to cover in full, but we think you will find it just as interesting. Now, this one comes from FinExtra with the headline, Hong Kong to issue first stablecoin licenses in early 2026. Hong Kong's Legislative Council has approved the Stablecoins Ordinance, setting up a regulatory framework for issuing fiat-referenced stablecoins. From that date, the Hong Kong Monetary Authority, or the HKMA, will start accepting license applications and enforce the new rules. Despite applications potentially opening in August 2025, HKMA expects to grant the first stablecoin licenses in early 2026, and only a handful are likely to be approved at first. Hong Kong seeks to cement its status as a major digital asset hub in Asia via this regulatory framework. I guess there's a couple of things on this for me. Look, I think stablecoins is a movement. First of all, I don't think it's going away, and I think this is another big step in that direction. But I think Hong Kong is also such an interesting market in this space. When you look at things like the things that HSBC was doing around like tokenizing physical gold and all of that sort of stuff, I just think it's super, super interesting. We have to be really quick on this one, but Ruth, I'm going to come to you for like 10 seconds of thoughts because I know this is a space you're particularly passionate about.
Yeah, stablecoins in Hong Kong. What could go wrong?
Perfect. Nailed it. All right. And finally, this one comes from FinExtra with the headline, Coinbase's UK musical ad hits a nerve, sparking debate from crypto fans to founders. Coinbase has released a 2-minute satirical musical advert in late July 2025, mocking Britain's economic struggles with visuals of leaking ceilings, overflowing bins, and £100 fish fingers, while characters cheerfully sing "Everything is Fine." The ad juxtaposes upbeat lyrics like "We ain't got no troubles, no reason to complain," with bleak imagery reflecting cost of living pressures and social decline. The ad was blocked by Clearcast, UK's TV advert approval body, for allegedly making unsubstantiated economic claims and missing mandatory crypto risk warnings. Now, trying to describe the ad in words doesn't quite do it justice. I think if anyone hasn't seen the ad that's listening to this, I would say pause and come back, but go watch the ad because it will really bring the whole thing to life. Ruth, again, I'll come to you first on this because, again, this is sort of crypto-based. It's interesting, isn't it? Because, I think it's been banned on a technicality, a quite important technicality around, warnings, messaging, and all of that sort of stuff. But it's, as with anything that gets banned, I suppose it's probably just given it a whole heap of hype and a whole heap of oxygen that they wouldn't necessarily have intended.
Yeah, I mean, there's been some sanction of like meme coin producers or folks who have, like Kim Kardashian, people who have promoted various crypto projects, and they have been sanctioned because they weren't supposed to do that. I would say that it's this kind of massive clash between really traditional advertising body or, a political class, which feels like you can kind of ban things into non-existence. And then, folks who are, kind of crypto early adopters are now, it's such a large percentage of the younger population who really believes in digital assets and crypto. I don't know that like a ban is a great way to confront those types of conflicts. I'm obviously not going to opine about the regulation that or the kind of broadcasting regulation that was breached. But it does feel like we live in an environment where there's an attempt by kind of the traditional elites to do away with discourse which challenges these kind of, traditionally held values. And I don't know that that's going to kind of change any minds.
No, completely agree with you. I agree with everything that you said. I think a much better approach might have been to, let them know what the issues were that might have led to the ban and give them some time just to address those issues. But I think, again, I'm with you 100%. I think that ban culture, fundamentally, I don't think it worked. Not least because, fair enough, there's the UK's TV advert approval body, but how many of the demographic that you just described are actually consuming those ads on TV versus, other digital media channels? Jasper, I don't know if being based in the US as you are, if any of this has made any sense to you. I mean, I think it makes, a lot of sense when you're in the UK and you're sort of immersed in that sort of doom and gloom that I think we've talked about as we go through the as we've gone through the show. But is this making any sense at all? And if not, I really apologize.
It may be alien, I think, to some in the US, but yeah, and I think you pointed to, this sounds like just really a classic example of the Streisand effect, right? You try to bury something and you just put more eyeballs on it as a result. I think not maybe having all of the the depth of the cultural context. I think I agree with everything that you and Ruth have said. You can't obviously, the disclosure laws, the rules it's incredibly important that everybody follows those. But if what you're doing is trying to block the use of negativity or sort of culturally discouraging images or stereotypes, that's always going to be an uphill battle. And I'm sure that Coinbase and any agencies they're working with have done their research in terms of what's an appealing ad.
That's for sure. And look, I think it's important to say, the ad doesn't explicitly promote, specific crypto products. It obviously promotes Coinbase as a brand. Brian, I'm sort of going to come to you because you've given us like one very positive and optimistic viewpoint on this show already about the sort of direction that we're heading from a sort of green banking and carbon footprint and all of that. And then you've given us a more sobering opinion on the Klarna story. What's your reaction to this one?
Spin the wheel and see which side I come down on. I actually feel quite good about this. I think I'm bringing more positivity. I mean, the ad's brilliant. So well done for that. The thing that's catching me out is like how much was it down to the fact. I think part of the reason was they didn't include some like basic sort of crypto, some small print basically, and I'm like, why not? And to what extent was the decision, based on that? And it was a ban for TV, but not an all-out ban. Yes, it's amplified it, but I think a couple of things. I think firstly, the medium brings is part of the message, right? So what you see on TV, especially I don't know if this is the case in the US, but in the UK, what you see on TV has a different weight to what you see online, and yes, that alters by demographic, of course, but I think that's probably still a broad truth in that. So I think that does still have an impact. Yes, it then gets amplified online, but it gets amplified in the context of that decision, and that itself is part of the messaging. So yes, we can all experience it, think about it, learn more about it, begin to break out of these old paradigms, as Ruth was talking about. But we can do that with just that little bit of caution, that little bit of, maybe I should apply my own faculties to this and think about the implications of some of these new tech and new new approaches. So yeah, overall, they made the right decision, I'm sure, because they have a bunch of rules that they follow. I think it's having a positive effect overall on the way the content is consumed.
Yeah. I think that's absolutely fair. And as much as we might have said, look, an alternative approach rather than banning it might be better. Of course, that doesn't, undermine the fact that consumer protections are incredibly important, and especially when it relates to sort of more complex and sort of emerging financial products. Cool. All right. I think that wraps up today's FinTech Insider News. Thank you guys so much for joining us. Let's go around the room and just maybe you can tell us where people can find out a little bit more about you and your companies. Brian, let's start with you.
Yeah, so online, cogo.co, and on LinkedIn. Get in touch if you want to know more. Happy to chat.
Excellent. Thank you, Brian. Jasper, how about you?
Yeah, I personally not very active on social, but you can find FS Vector on LinkedIn and at fsvector.com.
Amazing. How about you, Ruth?
So you can find me on LinkedIn, Ruth Foxe Blader, or you can follow me on Substack, Fox News.
Amazing. All right. Thank you, guys. As for me, you can find me on LinkedIn. And if you want to find out a little bit more about 11FS, you can find us at 11fs.com. Thank you so much for listening to today's FinTech Insider. If you like what you heard, please make sure to follow us on your favorite podcast platform of choice. And if you really like what you've heard, why not share the podcast with a colleague or friend? As always, if you want to join the conversation, find us on social media. Just search for 11FS or FinTech Insider or email podcasts@11fs.com. Thank you again, and goodbye.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's VANTA.com/insider.